All right, let's get right into it. Today, we're going to talk about two incredibly powerful, but honestly often overlooked financial strategies that could be sitting right under your nose. We're talking about cost segregation and R&D tax credits. So let me ask you something. It's a question pretty much every business owner has at some point. Are you leaving money on the table? I mean, is your business actually overpaying in taxes? For a lot of businesses, the answer is a big yes. And look, this isn't just some boring accounting thing. It's a real growth issue. When you overpay on your taxes, that's your cash, your hard-earned money getting locked up instead of being put back into your company. That directly limits your ability to grow, to hire new people, or to innovate. So yeah, let's just call it what it is. It's an unseen drain on your profits. It's a super common problem for businesses. But the solutions we're about to explore, well, they're anything but common. When you really break it down, these challenges fall into a few key buckets, right? First, just the basic struggle of keeping your money in the business, working for you instead of tied up in taxes. Second, actually knowing how to find every single property-related benefit you're entitled to, which is a huge task. Then there's just staying on top of all the tax law changes. That's practically a full-time job. And finally, trying to figure out what your savings could even look like down the road. It's a lot to juggle, for sure. Okay, so how do we start to tackle this? The answer, and this is the cool part, starts with unlocking something called accelerated depreciation. Seriously, think of it like finding a key to a secret vault of savings that you didn't even know existed in your own business. All right, first, a super quick refresher on what we mean by depreciation. All it is really is how you account for something losing value over time. But here's the crucial part. That loss in value is a tax deduction. So the faster you can claim that deduction, the more cash you have in your pocket today. And this slide just lays it out perfectly. The standard way of doing things, that's the turtle. It depreciates your entire building super slowly, over 27 and a half or even 39 years. But the accelerated method, that's the rocket ship. It gets way more specific, identifying parts of your building that can be written off much, much faster. We're talking 5, 7, or 15 years. And that is the whole point. That's the magic right there. This difference in timing, it isn't just some minor detail for your accountant. It is the absolute key to unlocking massive tax savings right now. And that means more cash for your business this year. So how do we actually make this happen? Well, the first strategy is something called cost segregation. And it's exactly what it sounds like. You're basically deconstructing your building on paper, piece by piece, to maximize your profit. Think about it this way. It makes perfect sense. A building's foundation is going to last for decades, right? But the carpet inside, that might only last 5 years. So shouldn't you be able to write them off at different speeds? Of course you should. Cost segregation is just the official engineering-based study that separates all those different parts so you can depreciate them over their actual, much shorter, lifespans. And right now, this is more powerful than ever, and it all comes down to one big, beautiful number, 100%. So what's so special about that number? Well, it's tied to something called bonus depreciation. For example, recent tax laws brought back 100% bonus depreciation for 2025. What that means is businesses can potentially deduct the entire cost of those shorter life assets. We're talking the carpet, the light fixtures, the wiring, all in the very first year. Now, that percentage can change with new laws, but the principle is still an incredible way to accelerate your cash flow. And I want to be really clear here, this isn't some shady loophole or some fringe strategy. This is a well-established, totally IRS-accepted, engineering-based approach. I mean, look at this. Over 55,000 of these studies have been done since 2003. It's proven, reliable, and incredibly effective. Okay, so that's your physical building. Now let's shift gears from your physical assets to your intellectual ones. Our second big strategy finds savings in a place you might completely overlook, your everyday innovation. We are talking about research and development, or R&D tax credits. And the reason this is so huge is that most companies are just leaving this money on the table. It's crazy. The data shows that, on average, companies are missing out on a whopping 40% of the R&D credits they are fully entitled to claim. And remember, these aren't just deductions. These are dollar-for-dollar credits against your tax bill. So what even counts as R&D? Because it's way broader than you might think. It's not just people in lab coats with beakers. It's the cost of developing prototypes, the raw materials you use, the wages for your employees who are helping to create a new or improved process. It's even payments to contractors you hire for research or developing your own internal software. So many manufacturing, tech, and engineering companies are doing this stuff every single day and not even realizing it's R&D. And finding out if you qualify, it's surprisingly simple. It's really just a four-step process. You select your industry, you plug in some of your qualifying expenses, a calculator runs the numbers for you, and boom, you can instantly see your potential benefit. It takes all the mystery out of it. Oh, and here's another kicker. This is maybe the best part. If you suddenly realize you've been missing out on this for years, you can actually go back and amend your tax returns for the past 3 years to claim those credits. That can result in a pretty significant immediate cash refund check coming right back to you. All right, let's bring this all home. The real takeaway here isn't just about two specific tax codes. It's about shifting your mindset. It's about going from being just a passive taxpayer to being an active tax strategist for your own business. So just to recap the big ideas to remember. First, your property is not just one big thing, it's a puzzle made of different pieces that can be written off way faster. Second, the innovation you're already doing every day in your business, that can be a direct source of major tax savings. And third, you need specialized engineering-based analysis to find these opportunities because your standard accounting might just miss them. So that really leaves us with one final question to think about. If you start looking at your own business through this new lens, seeing all the individual components instead of just a building, and seeing everyday innovation instead of just day-to-day operations. What hidden value is just waiting to be unlocked in your own finances?